Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I believe he was on in May. He is the Chief Investment Officer and founder of Bison Interests. Bison Interests is an investment firm focused on publicly traded oil and natural gas companies. He has over 15 years experience in investment management, 10 of which are focused on publicly traded oil and natural gas securities. He has a long list of accomplishments with stocks, especially in the oil and natural gas sector. He's built companies and sold them in the oil and natural gas sector. Josh Young, thank you for joining me again.
Thanks. That bio sounds great. I'd like to meet that guy.
I thought I summarized it. I mean, I read the whole thing last time. It was just a long list of accomplishments. You've accomplished a lot, and you sound like a fairly young guy.
I'm 38. One of my very first jobs out of school was doing executive compensation consulting. I only lasted a couple months because you're basically getting paid to rationalize overpaying CEOs and board members. But I noticed that there were people on these boards making crazy money under 40. And I thought, man, I need to really figure out what I'm going to do career-wise so I can end up doing something like that. And so here I am. I'm under 40, and I've been chairman of the board of a public company.
Very impressive. I have another friend like that, Nolan Watson at Sandstrom Gold. He has a precious metal royalty and streaming company. He built that company up. They're around $2 billion market cap with a lot of free cash flow too. But let's talk about the oil and natural gas markets. We're recording this interview on September 9th, 2022. The oil price is down. The U.S. oil price, West Texas Intermediate, is down substantially. I think a little over 20% in the last 6 to 8 weeks. It's at right now $86.70 a barrel. Even though OPEC just announced a 100,000 per barrel production cut earlier this week, I hear and read the phrase, quote unquote, demand destruction about oil and gasoline mentioned disproportionately by the mainstream financial media. Is there actually a lot of evidence that demand destruction is actually occurring, though?
That's a great question. There is a little. Some of it is not related to the economy, though. So there's a little bit less gasoline demand because there's still people working from home in the US and abroad. And so there's structurally a little less demand, although that's actually starting to come back. So a week ago, we saw Goldman and Morgan Stanley require their employees to come back to the office. And we're seeing some tech companies and some other companies just starting to require all their employees to come back in. So that's a bigger factor. The economic driven demand destruction is really tough to find. I mean, the joke on Twitter and elsewhere has been demand construction, because the more you look for economic driven demand destruction, the more you see higher demand than you'd expect. And then I guess just the one place where there's clear demand that's lower than it was previously is China, where they've been forcibly, essentially imprisoning tens or hundreds of millions of their people in these big citywide and sort of like region-wide lockdowns. So there's less demand, but I would also argue that's not really demand destruction. That's really something else, sort of like government mandated demand cessation or something.
And that's probably only temporary. I mean, I don't think they're going to be locking down for 6 months, 12 months, 18 months. So the numbers I've looked at with gasoline demand, jet fuel demand, there was a lot of people still traveling here in the United States and other countries. I think Australia just allowed plane flights. So you're starting to see a lot more other countries open up in terms of usage for travel again.
Yeah, I mean, there's some great numbers coming out from airlines where they're seeing very strong demand, and we're actually seeing much higher ticket prices and still strong demand. So you look at that, you look at their numbers for September, you look at their early guidance for October, and it's just hard to reconcile that with this narrative of the economy is doing terrible and therefore oil demand is down. And again, that's not a forecast. My old intern, Morgan Housel, he just put out this thing today on how difficult economic forecasts are and how people spend too much time thinking about what's going to happen in a year or two and not enough on what's happening right now. And I think I totally agree with him. And I think what matters for oil is what's happening in the economy right now, and right now, it seems like things are great. Again, other than China and their sort of government mandated lockdowns, from an oil demand perspective, I mean, things look very different from what you'd hear in various news headlines and reports and from various economic forecasters.
Yeah, I'm looking at the headlines on oilprice.com, and it's talking about some oil inventory builds the last couple days, last week or two. Rig count's down. Rig count being down normally is bullish for oil when there's less rigs drilling for oil, less new wells coming online, and that's still being spun as being bearish for oil, which is kind of head scratching.
Yeah.
Well, I want to ask you now about the comments last month from the Saudi oil minister. He talked about the physical market being tight. He talked about too much paper oils futures contracts. We had, I think, a couple weeks ago, we had Iranian crude oil sell for a $10 per barrel premium to the spot price. Have you ever seen anything like that before?
Yeah. So I don't think so. There's a lot of discussion around physical versus paper market, and there's weird trading patterns for the oil price recently that people have noticed. That, I mean, they are suspect, but I think it's easy to sort of get carried away on that side of things, and I think there's a much bigger point here that really is worth focusing on. So our last white paper that we put out, the most recent one we just put out like this afternoon, is on gas to oil switching in Europe and Asia. The one before that was on OPEC Plus, and it was sort of a continuation of work we've been doing for a while on OPEC Plus and their spare capacity. And our view is that OPEC is pretty close to out of spare capacity. And, you know, Russia is a little complicated, and some of the other OPEC plus nations are complicated outside of the core OPEC. But it looks like countries are mostly producing as much as they can on an unconstrained basis, unrelated to what their quota allowed amount is. And that matters a lot because when you're producing as much as you can, you're at risk of that production falling absent substantial reinvestment. And when you look at the activity levels in these different countries, there just hasn't been enough activity to really sustain production at the levels that it's at. And that's why you've seen production start to fall in a number of these different OPEC plus countries. And there's going to be a tendency for Saudi Arabia and other countries to lower their quota amount and lower their actual production amount because they may not be able to, at current activity levels, sustain the production that they're showing. So the reason that matters is when I hear the Saudis talking about this, I hear two things. One, I hear that they're frustrated about oil prices being too low from their perspective. And frankly, I'm sympathetic to that as the oil and gas investor, thinking that oil prices are too low. But I also hear recognition of this spare capacity issue that we've been beating our drum about. And I think it's gone full circle to the point where when I first put it out, people were making jokes about there being a bone saw with my name on it in Saudi Arabia. And now it's gone so full circle that the Saudis are talking about it, and people who claimed that it was ridiculous that we made claims about Saudi and other countries not having as much spare capacity as they claimed, now publicly will say, even like to our faces, that it was obvious and everyone knew it, and therefore it was fact. And it's like, well, you can't have called it wrong a year ago and then have it be known at the time as a established fact. Both of those don't work, and you can't have both simultaneously. But I really think the spare capacity aspect matters even more than the sentiment of the OPEC leaders. So I think you can read and hear what MBS and others are saying about the oil market, and then you can actually see their capacity. And I think the capacity matters most, especially given their history of very poorly managing the oil market. And they sent oil prices essentially negative a couple of years ago. They crashed the oil market in 2014. They kind of crashed it again in 2016. So I don't think you want to rely on their sort of sentiment. I think what matters more is what they're investing and then what they can actually physically produce.
Those are some good points there. And I'm sure you were getting it worse than me in terms of like the backlash. I know you were telling people for a long time that OPEC didn't have spare capacity. I was sharing the research reports. And then when I was posting these articles that you wrote, that you and your research team wrote from Bison Interests on Twitter, I was getting backlash from Bloomberg energy analysts who were saying that OPEC has plenty of spare capacity. And they were just harassing me nonstop. I think I had to mute or block a couple of them because they're adamant that OPEC efficiently reinvest their oil profits. All of the OPEC countries efficiently reinvest and could easily bring on spare capacity. And over the last, 4, 5, 6 months, we've had admissions from a lot of these OPEC countries that they just don't have the spare capacity.
Yeah, I mean, the sort of sad joke is that if you want to read some of the energy coverage for Bloomberg or Wall Street Journal from 6 months from now, you should read our latest white paper. So, and don't worry, it won't be cited. So that's my comment on all of that.
Yeah, my research ends up on Seeking Alpha a couple weeks later too, and I don't get paid for it either. Unfortunately, I'm seeing some articles that I wrote a couple months ago and almost word for word end up there. Anyways,
yeah, So just one more comment on that. So we actually looked at setting up a paywall and starting to charge for the research we're putting out. Less, I mean, money is great, right? Better than no money, but more because once you do that, it actually gets much more complicated for them to steal it and plagiarize it. And so, and there ends up being financial recourse. So, I mean, it's been pretty extreme. And then, so I think there's like two aspects to it, right? There's the like plagiarism aspect and sort of idea theft. And then there's also just this sort of very loose, like many of the people that hold themselves out, I think particularly in oil and gas, just because there was a downturn that was so long and severe that many of the competent people chose to leave and do something else with their lives or retire. So many of the people who are left, including, I think, people covering the space, hold themselves out as experts without any real expertise. And so I think it's challenging to provide differentiated work that's fact-based and provides a variant view. I think that is problematic for many holding themselves out as such. And so I think it sort of ends up as this like weird target at the time and then plagiarized 3 to 6 months later.
So a lot of people were actually surprised that Saudis and the OPEC announced a 100,000 barrel production cut. You and me weren't. They were telling people weeks in advance they were basically going to do that. And a lot of people still said they were surprised. Do you think that OPEC will be announcing more production cuts sooner than the market anticipates if the oil price continues lower?
Yes, but again, I don't think that's as related to their sentiment or their even like willingness or ability to control the oil market. I think it's more driven, as much as I'd like that, right? It's like painful for me to say, like, it almost doesn't matter at all what they're saying. And it almost matters entirely what their productive capacity is. And I can't emphasize that enough, right? Because no one believes OPEC for good reason. But you don't need to believe them. You just need to know what they can produce. And again, you can tell this without believing a word they ever say, right? You can see the third-party inventory numbers. You can see the number of rigs they're deploying. You can see the quality of rigs and how much they're paying for them. You can see the kinds of wells they're drilling. I mean, things look rough. They are paying a lot of money for very high-end equipment and tons of expats to come in, and they're still not really growing their production capacity. So I don't know. I think I would not focus so much on what they're saying. I think really it just matters what they can do, and what they can do is very limited, and they're looking for excuses to cut production. So baseline, I would expect them to cut production almost regardless of what happens with the price of oil. They just need some political cover to cut so they don't look like they're manipulating the price much higher.
I know you look at a lot of this data very closely. Are costs going up for a lot of these OPEC producers enormously? Because Diamondback Energy announced in their Q2 earnings that their drilling costs for wells are up over 15% year over year. Are these types of cost increases the new normal and about average for US oil and natural gas producers and also maybe for OPEC, or is it above or below that 15% increase number to bring a new onshore or offshore well online?
So OPEC cost inflation is a little different. It's still up, but there are fewer cost pressures on their activities. And I think they're probably actually closer to that sort of 15 or 20% number. My guess for Diamondback in terms of why their costs are only up 15% is probably related to them having some of their services contracted and having pre-bought certain equipment and downhole tools and pipe and whatever. My expectation is that if you looked at their sort of spot costs, so not anything they've pre-bought, but everything they're paying for today and what it would cost them or what it's costing them today to sort of re-up their equipment to restock, to drill their next wells, my expectation would be that their costs are up, as well as other shale producers in the US, likely up closer to 30% year over year rather than 15%. I mean, it's pretty... wages are way up. Day rates on drilling rigs are up more than 30% year over year, I believe. Pressure pumping's way up. I think pipe and tubing and stuff is up 300% or something ludicrous over the last couple of years. So yeah, I think that's actually a low end number, probably more indicative of what cost increases look like in Saudi Arabia, and probably a lot less indicative of what actual cost. And again, I'm not saying that Diamondback is misrepresenting it. I think they're just appropriately blending their sort of good supply chain where they've been able to pre-buy some things when they see prices about to go up, along with their sort of spot pricing. And my expectation is that there's some embedded cost increases for shale producers and others that maybe they're not having to show because of these forward purchases.
That's interesting. So you're saying that the management team at Diamondback has done a above average job of maintaining costs instead of letting costs go totally out of control, like some of these other companies where costs are up over 20% then. So they're kind of on the lower end of the cost increases.
No, I'm just saying that their representation, I was trying to sort of back into where that representation would come from, given what I'm seeing from actual cost increase. And so different companies are going to have different amounts of services that they pre-purchased or contracted ahead of time. And depending on when they contracted and how much they bought, there's going to be different price increases. And those price increases are going to kick in at different points. It's like looking at rent, right? So rents are way higher right now than they were a year ago. But if you go find people in a building, right, let's say that everyone had 1-year leases. Well, if rents have been rising, and let's say rents were up 30% in a year, well, on a blended basis, your rents aren't actually up 30% if rents were up, let's say 30% over 6 months even, because only half the leases would have been renewed. So there are some legacy costs that I would guess are in there based on older contracts. But when they renew, do the equivalent of sort of re-signing their lease, the expectation that I would have is that their costs would be up more than that. So not a reflection. I mean, Diamondback is a fine company, but not saying that they're lower cost or higher cost, just explaining where I think a 15% number would fit into costs that are rising, sort of the actual today price for these higher. Similar to if you're looking to rent an apartment today, your price is not necessarily the same as the average price that's being paid by people living in that building for the same size unit.
Okay, that makes more sense. But costs are still trending higher though, right?
Yes, substantially.
So costs are still trending higher. There's still supply chain problems. There's still problems with steel pipe casing. You said prices are up. I heard it even a couple months ago after we did our first interview that there were oil service companies that still had problems either with labor. They either had to raise wages. They had to bring people away from construction, home construction, although now that might not be a problem. But to hire people months ago, they had to offer higher wages, and they were still having supply chain problems with key parts.
Yeah, I mean, the labor issue hasn't gotten better. It's still really tough. And, you mentioned that point about construction, I think there's some issues with the way that people are evaluating the housing market and housing data. And this isn't something I'm an expert in. I just noticed that there are some challenges there where it doesn't appear that, at least yet, there's been a substantial downtick in housing related employment. So not that it won't happen, but and again, this matters a lot for oil because oil consumption is based on what people are doing today. It's not based on what people will or may do X number of days or months or years from now. And so I just don't know. I don't think if a construction worker is busy now and the home builder is sort of burning down their backlog, but still has, let's say, 6 months of backlog instead of a year, that construction worker is still getting paid. They might even be getting paid more because of wage inflation broadly, and they're still driving their truck to and from work and burning a bunch of gasoline. So that's sort of where I've been looking. Again, you hear enough about demand destruction, you start looking around for it. And I think that narrative, it probably happens. We probably have a pretty bad housing slowdown, although who knows? And it's not something I'm an expert in, but it just hasn't happened. Like prices are starting to fall, but it just hasn't hurt yet, sort of that new build employment in the US.
Oh, I was going to bring up the point that Cuppy is often brought up, how a lot of these workers in the past, they switched from oil service workers drilling shale fields, they switched to home construction. So Cuppy's thesis is that they will be switching back from home construction to oil services, and the oil service companies are going to have to charge, they're going to have to pay much higher labor fees to bring them back.
Yeah, that's an interesting thought. Yeah, I mean, I think that's a reasonable expectation. I just don't know. My point was less that it's not going to happen and more that it doesn't seem to be happening yet. And there's actually a crazy issue in oilfield services where the offshore rigs pay better than the onshore rigs, partly because people don't really want to have to be staffed on a rig in the middle of the ocean, 2 weeks on, 1 week off, or whatever. So partly people don't choose that, and so they need to get paid more money for it. But also, if you're really good at something and it's a skill that's relevant both for offshore and onshore, and if you're especially if you've passed the relevant safety classes and certifications, let's say you used to work offshore before offshore really fell off and then you went to an onshore rig, you're getting poached right now to go work offshore and you're getting paid a lot more. And so we are seeing some oilfield services workers that are working on onshore rigs or pressure pumping leave to go work on offshore rigs. They get paid more, but they also are frequently some of the most experienced, essentially best experienced workers on rigs and on pressure pumping and various other services. And so, it's not a huge issue right now, but in an environment where you're struggling to keep your rigs and other oilfield services equipment staffed, having some of your best people leave is really hurting. And we're seeing it in productivity stats in terms of drilling days per well and some of the other stats. I mean, it's an issue. And I think that's an issue broadly because there's insufficient labor available. And then it's a extra issue because some of the best people are getting pulled offshore.
And I was looking at some of the numbers for the Q2 for these oil service companies, and you would think with oil and natural gas prices where they are, and especially more natural gas wells being drilled here in the United States, where there is actual growth in natural gas wells, I think over the last 6 or 7 months, you'd think that the oil service companies would actually be generating some free cash flow, would be able to raise prices. But Schlumberger had an absolutely horrible Q2 number. I think it was negative. They were cash flow negative. So do you think then that these oil service companies are going to have to raise prices because they have supply chain problems? They're going to have to bring in more labor. They're going to have to raise prices in to drill new wells in the future, and they're going to have to pass those costs on to producers. So that's going to create I don't know if it's going to affect anything in the short term in a couple months, but in the years to come, that's going to be a much higher cost floor for oil and natural gas prices and drilling new wells.
Yeah.
So you think then that Schlumberger, one of the main problems then is if their cash flow numbers are that bad, like one of the main things that they can solve, they're going to have to raise prices substantially then?
Yeah, I mean, we're seeing it already, right? So we're seeing services costs rise. We're seeing the costs that services companies have to pay rise, and they're able to pass it along and then maintain their margins in some cases or increase their margins. So yeah, it's an issue, and it's actually pretty interesting because it's so tight that even though there's less demand a little bit for services right now than there was, let's say, 3 months ago, because oil is at 85 and not 120. But even with that sort of incremental less demand from that lower price and the extreme price volatility, which I think scares people maybe even more than the spot price being lower, despite that, you're still seeing oilfield services price increases that are substantial. So I think OFS is really undersupplied. Labor is a real issue, but it's not the only issue. And yeah, I think things look great for oilfield services. And the two ways that I'm playing it are I'm interested in low decline producers because they just don't need to drill that much. So they're much less susceptible to CapEx related cost inflation, and owning services stocks themselves. I'm not going to talk about any specific names or anything, but just I think I do spend my days when I'm not messing around on Twitter. I spend my days analyzing individual securities, and from what I can see, I mean there are amazing opportunities. I think broadly in oil and gas, and specifically in low decline producers and in select services providers.
So in your opinion, is the oil and natural gas sector the best sector still to find free cash flow growth and dividend growth at reasonable valuations?
Yeah, I mean, I'm not regularly scanning the overall market trying to reassess if oil and gas is the absolute cheapest. What I'm doing is making sure that oil and gas is cheap enough for me to stay in, and making sure that the long-term macro perspective that I have is calibrated and still makes sense and hasn't sort of changed or broken in some meaningful way.
So I want to ask about natural gas above oil now. Natural gas has outperformed oil, I think, over the last 2 years. Are primary natural gas producers making a lot more free cash flow with better profit margins than producers who have a larger mix of their production focused on oil?
No. So the price is up, but margins were terrible in natural gas, let's say 3 years ago, whereas margins were okay in oil. So oil going from 50 to 80, but oil producers having, let's say, $20 a barrel margins on production, not on sort of full cycle. Their margins have expanded less than a natural gas producer that was producing at $2 an MCF, and now they're producing at $8. Obviously, the margins expanded a lot more at $8, but the actual profits they're generating, in many cases, the oil producers are still making more money because they were making money at 50 and now they're making more money at 85. So, I mean, it really depends on the specific company. It also depends on the field. So natural gas is generally lower operating cost to produce because you end up with trying to get oil out of these days very tight rock, and gas, not surprisingly, moves more easily through the rock and escapes it more easily than liquid hydrocarbon coming out from the rock. And so there's fewer problems with gas production. Gas production can stay on there's less stuff that goes wrong and therefore less cost associated with it. But still, oil production has been more profitable. And I think you'd need to see, at least in the US, in Europe and parts of Asia, where you're talking about $75 an MCF or whatever, right? Like hundreds of dollars a barrel of oil equivalent. The gas is almost definitely more profitable. But I was focusing on the North American aspect.
Yeah, I actually got an argument with a guy who's like a deflationist. He worked in the technology sector, Silicon Valley, and he shared I think a Wikipedia article talking about one enhanced oil recovery that was tested on a few wells where the cost for enhanced oil recovery would drop to substantially enormously. But normally when I've looked at enhanced oil recovery, it's very, very expensive to either water inject wells or these other enhanced oil recovery techniques. You're looking at much higher cost structure to get the oil out.
Yeah, I mean, it just depends on the project, right? So some oil sands, some enhanced oil recovery, especially if you're buying and transporting CO2, or putting in surfactants and polymers and various other things that can be quite expensive. I mean, those can be very high cost, but there's also relatively low cost oil sands, and there's relatively low cost. I mean, water flooding doesn't necessarily cost a whole lot. And especially if you're early on in a water flood, if you're just pumping water downhole and getting oil up, and if you have a good oil to water ratio, I mean, you might not be paying much to actually produce that oil. So, really, I think it just depends. I think the whole sort of cost structure from the industry was misrepresented in the sort of shale boom and bust. And I think, I mean, the companies are making money right now on a operating cash flow basis because oil's over 85 and natural gas is like $8 an MCF right now. But they wouldn't be making, and they didn't make that much money at lower prices. And on a full cycle basis, they don't really, I mean, you need high prices, especially as services cost rise, to generate an attractive full cycle rate of return. So I think there's a lot of sort of weird narratives around, like a whole bunch more rigs are just going to show up and a bunch of production is going to turn on. And you get this very weird public policy stuff where you have politicians simultaneously talking about fossil fuels going away and angry with oil companies for not, just from their perspective, turning a valve to turn on more oil production. And, it's expensive, it's hard, it takes a while. And I think we're seeing it. I mean, even EOG announced the other day, their estimate is that the US is going to grow production. I think it was 300,000 or 400,000 barrels a day less than the EIA's forecast for 2022. And they were saying even less for 2023. And they're probably the number one independent producer here in the US. And so, I think it makes sense to pay attention to them and to think that that's not unique to them. And they're pretty well positioned to be able to estimate oil production growth onshore US, considering that they're a pretty big part of that.
So you think in the next 6, 12, 18 months, the market's going to be very surprised that there's not going to be a lot of new supply, despite oil and natural gas prices where they are. I know we talked about this in the last interview about Russian oil production. I know the Russians are still selling their oil to China, India. I think the Saudis even bought some, but we discussed this, that the Russian oil production could, over the next 12 to 24 months, that could decline as well.
Yeah, it could. I think it probably should, absent some sort of real significant intervention. But I think people got a little too excited about that and thought that Europe was going to fully cut off their imports. They're not, and thought various things in terms of millions of barrels a day coming off the market. Because there was a moment, I think in April, there was a month where there was a lot less Russian oil exported than everyone expected, and it was sort of a head fake. I think it's reasonable to expect that by, let's say, this coming April, there will be about 1 million barrels a day less of Russian oil production versus how much there was shortly before Russia invaded Ukraine. So it's some, and it's material in a market that's pretty tight, but it's not the sort of 3 or whatever million barrels a day that Bloomberg and others were reporting. And so that matters because oil prices should be higher, but they probably shouldn't be the $140 a barrel that we saw a few months ago.
So last question before I let you go. I've been seeing the dividend yields for a lot of these oil companies. There's been a lot of dividend growth the last 6 to 8 months. Do you expect that trend to continue? Or do you think with the variable dividends that a lot of these companies have, if oil and natural gas prices do have a nasty correction, there's going to be large dividend cuts and the sector is not going to be a good source for dividend income for a lot of investors going forward?
Oh, yeah. I mean, I think it's a mistake to own oil and gas producers for dividend yield like for dividend income that you need to live on or something like that. Like, I think that's not really investing in cyclical businesses for equity yield is pretty tough. It's not to say that I won't own companies that pay dividends, or that I won't try to own more of companies where I think they might start paying a dividend, or where their stock could re-rate because they start paying a dividend. But I think it's pretty tough, right? Because it's a pretty junior claim on cash flow. And if oil were to go to, let's say, $65 a barrel, which could easily happen if there were a terrible, like, rapid crash in the stock market, and if there was a significant economic downturn across multiple countries and maybe even multiple regions, you could see oil down. And I think the sad part is there's a number of people that are paying really high valuations, relatively speaking, for producers because they're paying dividends, and that could end in pain. That doesn't mean I think that oil and gas producers aren't really compelling here, and even the average ones are pretty interesting. I think there's just some that are way more interesting than average, and mostly, from what I can tell, they're not paying large dividends. Like, the larger the dividend, in many cases, the more full the valuation of the equity is. And again, not intended as financial advice, just my sort of speculative observation on the relationship between dividends and valuations here.
Do you think then that the free cash flow that these better producers you're talking about, it would be more widely used, instead of increasing dividends, then on going and buying assets that are discounted, mergers and acquisitions?
Yeah, I've been a big fan of a lot of the M&A in the last couple of years. What I haven't liked are these sort of like public-private deals where the public company awards a huge amount of stock, and it's like a one-sided deal where the private company wins. There have been a few of those, and it's very weird. In many cases, the public company will be partly controlled by private equity funds that vended prior assets in. And so I don't really understand the dynamic, but that really sort of rubs me the wrong way and reminds me of how the industry operated during the multi-year downturn, where it was pretty hard to justify owning these things. But I think overall, a lot of the acquisitions have been very favorable to the acquirers. And like, I'll pick on Devon, which I don't own. And, it's one of those sort of high dividend payers. But they also came in and bought a couple of different assets in the last, I think, 6 months, 9 months, something like that, at prices that were well below their corporate valuations. And I think they were mostly paying with cash, and it was just cash that they would have used for buybacks or dividends. And so if you're at, let's say, 5.5 times cash flow, 6 times cash flow, and you buy an asset for 2.5 times cash flow, especially if all of your cash is being used either to pay a dividend or to buy assets, right, net of your capex to sustain your production, you're better off, and under most circumstances, to just go and buy more assets at that very low cash flow multiple. So yeah, I think there's a number of assets available. They're transacting. The valuations are still pretty low. And especially as these sort of mid cap to larger cap producers trade to this sort of 5, 6 or so times cash flow multiple, I think there's a really good opportunity for them to show substantial accretion. And I'm way more comfortable holding a stock that's re-rating because they're doing accretive deals than I am holding a stock that's re-rating because they're starting to pay out their cash in a dividend. And again, not to discourage companies from paying dividends. I think it's a good idea. If you're a 2 times multiple public company, you should not go buy assets at a higher valuation. You should distribute your cash flow or buy back stock. But if you're a 5 or if you're a high valuation company, the market's telling you that you have a cost of capital. And the appropriate thing from my perspective is to do accretive deals. And an inappropriate thing, I think, is to pay up to return capital.
And do you think then that if there is a temporary crash then in oil and natural gas prices, that some of these low cost producers that have good profit margins still, they have some free cash flow, they don't have a lot of debt on the balance sheet, they're going to be more aggressive than in past cycles, and they're going to actually deploy cash, maybe a little bit of debt, to go and buy those assets. So when the cycle turns back to being bullish oil and natural gas, then they're going to be better off a couple of years from now?
Not necessarily. So I think there's actually a risk in being a dividend payer where you're paying out a lot of your cash flow in a dividend, because if you do that and there's a downturn and you're not heavily hedged, you could end up generating insufficient cash to be able to fund your dividend. So then you have to choose to borrow to pay your dividend or to cut your dividend. And I've held oil and gas companies when they've cut their dividends, and it is not fun.
Yeah, it's
And
ugly.
the thought was, hey, the intrinsic value was there. And, in a couple of cases, those stocks did eventually recover substantially to multiple times where they were before they cut their dividends. But it doesn't matter. It's still really ugly. And so I think there's this just very weird setup right now where a lot of the sort of mid to large caps are very richly valued, relatively speaking. And there are small caps that are much less richly valued. And the large caps have big claims on their cash flow through these dividends and other sort of programs they've announced. And the smaller companies, in many cases, don't have those claims on cash flow. So even if they're slightly higher cost producers, or there's various other reasons why people don't like them, I think the smaller caps in some cases are substantially advantaged. And then there are some other benefits, like smaller caps in many cases have lower production decline rates because they typically have more mature assets. And there's various other positive attributes as well. So I think there's a very big, I don't think there's a lot of money that's doing sort of stock picking in oil and gas because people make it so much about the macro. But I think there's really compelling opportunities here as a stock picker. And I think there's room for some of these smaller companies to get big fast through acquisitions and potentially re-rate up to that sort of 5 or 6 times type number. I think there's going to be a lot of deals as Devon and others who, again, like I think Devon's doing the right thing going and buying these assets at such a low cash flow multiple. And the market seems to agree as they keep bidding up their stock. So I think the market sort of agrees with me, but it's weird because the market agrees with me, but it's not bidding up some of these small cap companies yet. And you're not really seeing acknowledgement of how attractive this stock pickers market is in oil and gas equities.
I think the larger pools of capital, like the mutual funds, the pension funds, are going after the dividend yield because in the bear market for the general stock market right now, and it's probably going to be trending downward, especially if the Fed hikes rates, things in Europe get worse with their energy crisis and the other problems. You're going to see more of these larger pools of capital start going after dividend yields and trying to buy and hold anything with a sizable dividend yield. And the S&P 500, the majority of the largest dividend paying companies, I think out of the top 10, a lot of those were oil and natural gas producers in the last 12 months. So I think that's why they're desperately trying for dividend yield in a bear market.
Yeah, it's entirely possible. But again, I think that's setting up. I think when people are hurting, they'll often do things that set them up to hurt more. And it's just, it's sort of painful to say. I managed Bison through a multi-year bear market for oil and gas that was very tough and had to fight a lot of these urges to succumb to these sorts of different mistakes that people often make from a portfolio management perspective. And I think this is a mistake. I think that these companies, like they should be buying oil and gas because it's very cheap and compelling. But, like the news just came out, Buffett just increased his stake in Oxy and, wonderful, right? He went from 20% to 26%. We put out a white paper on this too, sort of evaluating Buffett's history in oil and gas. And he's clearly making a macro bet. But Oxy is not well run. Their management bet the company and almost went bankrupt in an unnecessary fight with Chevron, which was just ridiculous. And the stock's not cheap. And so all these people, I think, are following Buffett into Oxy. And a lot of funds have a sort of similar idea of coming into these sort of larger liquid names. And they're paying like 3 times the valuation per barrel of oil produced per day and 3 times the valuation for proved reserves just to be in a stock that's more liquid or because some famous person is buying it. And it's like it's the strangest thing to me to see people choosing to put their individual relatively small amounts of money into Oxy, for example, when a young Warren Buffett would never in a million years buy Oxy here. Like, it just completely the opposite of how he managed his money in the Buffett partnerships prior to Berkshire, and even in the early days of Berkshire. He just didn't buy when there was a large liquid company at 3 times the valuation or 2 times the valuation, or a smaller company that was illiquid. 100% of the time he was buying the smaller company that was illiquid. So I know it's like a little bit of a tangent, but people are buying Oxy because Buffett, and I don't own the stock, and I'm not making any sort of recommendation on it, but they're buying Oxy because of Buffett. They're buying these other stocks because of dividends or whatever. And I think there's just really interesting opportunities as some, I guess, predictable asset allocation decisions are made that I think end up proving to be pretty poor investment decisions.
Yeah, I've read a lot of Warren Buffett and value investing books, and he said he can't really buy small caps anymore because they won't move the needle. And Berkshire is so big with deploying capital that he'd have to buy like 100% of a company for a small cap, and even then it still wouldn't move the needle. So he said if he was back to being a young adult again and managing small pools of capital, he could buy small cap companies and he could produce, I think, like compounded annual returns of 40-50% like he was when he was a younger adult. But he said he can't do that anymore because he has too much capital to manage.
Right, absolutely. And none of this was a criticism of Warren Buffett. It's more an observation that my aspiration is to invest like a young Warren Buffett. And I think there are these great opportunities to basically take the cue from Warren that there's this great opportunity in oil and gas, and owning companies like Oxy can allow one to benefit from higher oil prices, from the inflation trend, from low valuations, et cetera, and to channel your inner young Warren Buffett, where you get to go buy the ones at a third of the valuation of the Oxys of the world. So again, I think it's really interesting to look at his history in oil and gas, his overall investment performance, which again, he's like living proof that the efficient market hypothesis is invalid. Okay, so if you can figure out that the market's not efficient, and you can find the person who's like the best in the world over the longest period of time, and he's going and buying oil and gas stock, but he can only go big, and you can value these things. They're not hard to value, at least sort of using high level heuristics and metrics. You can find, why not go and do essentially what young Warren Buffett did? And so I think it's a great opportunity. It's really interesting. And it feels a little more comfortable to be buying oil and gas stocks here, given all this volatility, watching Warren Buffett go and pay up for a larger, more liquid stock in the space.
And David Einhorn and some of the other value investors, and they normally would not buy any mining stocks, base metal miners, or oil and natural gas. And they're buying some of these mid-cap names too. I think Southwestern Energy and some pipeline companies.
Yeah. I think there's less signal there, and there's more signal with Warren Buffett. And I don't think that's an aspersion on anyone else. I just think it's sort of like all the efficient market hypothesis proponents, they all struggle with rationalizing Buffett and his outperformance. And we looked at his performance with natural resources, in particular oil and gas stocks, over his career, and it's quite impressive. And I think there's a reasonable argument that there is signal in his purchases. And then looking specifically on his comments about Oxy, and looking at Oxy's financials and assets, and having spent way too much time, frankly, evaluating Oxy from many different perspectives, I feel very good about owning similar companies at much lower valuations.
Yeah, Buffett really screwed up his purchase of ConocoPhillips. I think that was one of his biggest losers in his entire career. He bought it right at the top, I think, in 2007 or 2008, and then the oil market crashed. And then he sold at the bottom, I believe.
Yeah, so that was not perfect. And he had one or two other, he messed around with Suncor a little bit. I can't remember how he did with that. He had one or two other oil and gas purchases that weren't perfect. But if you look at it in aggregate, I think while he's been in the market with oil and gas equities, his performance, at least in the context of Berkshire, has been better than his average performance over sort of all securities. So he's done, even with a couple of mistakes, which frankly, he's made other mistakes too. No one's perfect. And anyone that says that they make every investment correctly and never lose money, they're just lying to you and trying to steal your money or whatever. So he's not perfect. but he has done extremely well, and he's done extremely well in oil and gas. And, I think it's my takeaway from his purchases of Oxy is that there is this great opportunity in oil and gas now. And the way I'm playing it is just trying to pretend like I'm the young Warren Buffett and buying smaller companies at much bigger discounts to intrinsic value.
Well, I really enjoyed our discussion today, Josh. I want to thank you so much for your time. If my listeners want to check out your research at Bison Interest, follow you on Twitter, how do they do so?
Bisoninterest.com, our website. We put up our white papers up there. And then our Bison Twitter is just at Bison Interests. And if they want to see my personal Twitter, where I'll share sort of more relevant oil and gas news and other interesting things happening throughout the day, Josh_Young_1.
Yep. And you're also doing barbecue and grilling tips there too.
That's it's BBQ time, I think, or it's Bison BB, something like that. I like to grill. And so I set up a hobby Twitter account too.
Well, you're down in Texas, right? So that's one of the best spots for fresh barbecue.
Absolutely. Thanks a lot for having me on.
Excellent. Well, have a great weekend, and thank you again for your time.